Hello, this is Quanry Invest. So the stock market is freaking out again. The stock market is extremely worried now. So we have the fear and greed index over here, which is around an extreme fear. It's in 19. And on every single metric here, we're basically in extreme fear already. So why exactly is the stock market fearing out? So as usual, the stock market is fearing out because of tariffs. So Trump delayed his tariffs on Mexican goods until April 2nd. And despite that, the stock market is not buying it. It's still tanking. And over the past few weeks, we've had a lot of different things compounding and adding on to the stock market dropping down. So we have tariffs, we had the Atlanta Fed GDP number, and we had all the jobs data which came out over the past few days or so, and it showed an extremely weak economy. So the weak jobs data can be attributed to a few things. It can be Doge, it can be an actual weakening economy that is going on right now, and the market is worried. So let's look back at what happened during Trump's first term as president. So as you can see over here, during his first term, he introduced tariffs multiple different times. There was one period where we had a 12% pullback, and then another period where we had around a 20% pullback. So in Trump's term, there will always be volatility, both on the upside and on the downside. And now we're in the down cycle of Trump's volatility. So I do expect that there will be a lot of more volatility ahead, especially in Trump's term, and maybe the stock market could fall another 10-20%. No one knows. But what we know is for Trump, he basically relies on the stock market for his presidential term performance, meaning to say he always talks about the stock market. He doesn't want the stock market to fall during his presidential term. And over here, after the trade war here, the stock market just went up and up and up and up and up until this COVID crash happened. And after the COVID crash, it recovered almost immediately. So for Trump's term, there will be a lot of volatility ahead. Be prepared for it. So let's look back at history. So in the past 100 years, almost every single year we've had a worry. So there's been crashes, influenza, all that, and yet the stock market is still going up. So if you're a long-term investor, what you should be focused on is the long term. Shrug out all the volatility, ignore it, ignore the noise, and just invest for the long term. Buy quality businesses and just hold it throughout all these different cycles. So over here, as you can see, there's a 5% pullback 3 times a year, 10% pullback once a year, and then 15+% pullback once every 2 years, and 20% pullback every 3.5 years. So volatility is just neutral. Volatility is nothing. Just allow the stocks to go down so that it will go up again, it will rebound. But what you need to do is to stay invested, stay in the markets, because you never know when it will go up, you never know when it will recover. But if you're looking to add to your positions, add it slowly because the markets now are overvalued. So over here, you can see that we are quite overstretched as compared to the EPS estimate, meaning to say that valuations and valuation multiples are extremely high right now. We're currently trading at around a 26 times earnings for the S&P. It is quite high historically, and I expect that multiple to come down over the next few years or so. And when multiples come down and when your earnings come down at the same time with all these tariffs and all that, then expect a crash to come. With that being said, here are some stocks that are looking like extremely good buying opportunities right now. So the first stock here is Amazon. Amazon is an incredible business. They have multiple different businesses going for it. And I think now that Amazon is down around, I would say 15% from its highs or 20% from its highs, it is currently presenting a decent buying opportunity if you're looking to buy this and hold this for the long term. So first stock is Amazon. Second stock is Microsoft. So another Mac 7 company. The Mac 7s have been hit very hard recently. Microsoft over here is down around 5% in the past month. In the past 1 year is basically flat. So this company over here is currently trading at a 31 times earnings, a 28 times forward earnings, and I think it is presenting a decent buying opportunity as well. Next company is ASML. So ASML is one of the greatest monopolies in this entire world. It is the company that sells the machines that create all your different AI chips. So you have your EUV machines which create the AI chips, and then you have your DUV machines which creates all your different technological items like your TV, your toaster, your refrigerator, and all that. So ASML holds an 80-90% market share in that department, and then it holds the monopoly in the EUV market. So ASML over here is currently trading at a 35 times earnings, 27 times forward earnings, and if you look at the price action for ASML, it's just terrible. It's down around 35% from its highs. And I do expect it to recover over the next few years, although it'll be a very cyclical one. Next, let's swap over from the US market to the Chinese market. I think the Chinese market right now is still presenting a decent buying opportunity if you're looking to buy cheap stocks that are cheaper relative to the US counterparts. So over here, you have Alibaba. Alibaba is up around 60% year to date, and it's still currently only trading at a 20 times earnings. So if you have to compare that to your other AI companies in America, like your Amazon. Amazon is currently trading at a 36 times earnings. So over there, you can see the disparity in the valuation over here. So the thesis for Chinese stocks is that they can start leading in AI. They can start basically rivaling the US American companies. And if that thing can happen, then you could easily see all these Chinese AI companies growing up, basically rising up in terms of the stock price, while the US companies decline. So if the story is that the US are losing out to the Chinese, then the Chinese will start mooning, the US will start coming down. So there's a Chinese company that I'm looking at right now. The company is Meituan. So what Meituan basically does is it's basically a Chinese Uber. So they do all sorts of delivery services and they hold a monopoly there with 80 to 90% market share. And they're actively using all the different sorts of AI infrastructure to improve their delivery. So now they're using drones, they're using sort of like artificial intelligence robot to deliver all these different meals. And I think this company over here is not cheap right now. It's currently trading at 28 times earnings, but it is one that I'm looking at and it's quite interesting to me right now. So there's another Chinese company that I'm looking at. This company is Baidu. So Baidu is basically the Google in China. They have the sort of like the search engine monopoly over there. So for Baidu, it is a declining business, but the valuation is extremely good for this one. So over here, Baidu's book value is around 263 billion yuan, and if you were to type it inside here, it is around 36 billion in USD, and currently the market cap for Baidu is around 32 billion. So Baidu is a company right now. It is not a real estate company, but it's trading less than its book value. So a tech company trading for less than book value with a robo-taxi fleet that's coming out soon, with the monopoly in the search engine over there, I think it is a decent one I'm looking at right now.